So we wrote up notes for this session.
Yeah.
And the notes go as follows. Satoshi was a fucking genius. And Bitcoin is amazing. And that's it. Thanks for coming to our TED Talk. That's it.
In support of our panel, I actually used ChatGPT to come up with my notes.
Really?
Yes, I wanted to increase compute demand.
Wait, you used ChatGPT, not a different
Perplexity,
model?
no. I use ChatGPT. I'm a loyalist to Sam Altman.
Okay.
So the idea of this panel is, with reference to Bitcoin, energy to compute and the supply chain. So we go from hydrocarbons or alternative sources of energy, which we'll talk about as well.
It's hydrocarbons and nuclear isotopes.
Yep.
Much love to alternatives. We're not doing that.
So from the ground or the sky or plutonium to energy, power plants, to substations, to data centers, to compute, to applications and software. So let's start off with we'll go with the whole classification of what is the energy to compute infrastructure stack in your mind.
Yeah, so I think in the context of Bitcoin mining, right, and what's been happening in crypto, we think of crypto as software. Bitcoin actually started as a hardware and infrastructure industry, right? The Bitcoin network, the first block was mined by someone using just a regular computer. It used to be a fun thing to do back in the day, to hash a block by hand. I don't know if anyone followed the Bitcoin talk forums, but that was a really fun moment in time. Then obviously 2013, 2014, Bitcoin network started to grow. Hash rate started to go up, difficulty increased, and we saw the advent of the ASIC era. Back then, it wasn't really such a massive industry, but around 2017, 2018, the Bitcoin industry became an incredibly large infrastructure industry that was dominated by custom hardware, and we hadn't really seen mass-scale capital going into funding hardware. Post-CPU, post-cloud computing, there really wasn't a lot of traditional investing in new form factors for semiconductors. ASIC pioneers, particularly Chinese firms like Bitmain and others, were really the first in this Web 2 B2B software investing era that invested heavily in new hardware. We also saw the advent of new business models for how people got energy. And so I like to think that Bitcoin really pioneered this business model that I call the energy to compute value chain. And what it is you build a data center, right? Or you build a compute factory, if you will. You need a site, you need land, you need a building, you need a cooling system. You can do air cooling or you can do immersion, where you immerse your chips in a fluid that off-takes the heat. You need, obviously, the chips themselves, so you need a robust semiconductor industry, and then you need a fuckload of power. You need connectivity, and it needs to be high-speed connectivity. Now, the nice thing about Bitcoin and ASICs is you don't need memory, right? You don't need storage, you don't need memory on chip. For AI and HPC, obviously, and CPUs as well, you need a ton of memory, you need a ton of storage. And then basically you produce this digital product. In the case of Bitcoin, you have a fungible digital commodity, Bitcoin, that's produced. In the case of compute, you have a non-fungible unit of a virtualized service, but there's this whole nascent industry that's emerging. What's happening in the compute space today, it's the biggest capital deployment into infrastructure and hardware since post-World War II. And I think that's incredible. And I think there's a lot that we can learn as an industry. We pioneered this. So I think it's only right that we own the future of the energy to compute ecosystem. And we're starting to see that happen. But that's what I want to talk about. I don't think we talk about it enough in our industry. And I don't think we give Bitcoin enough credit for really making it possible for AI and AI compute to scale so quickly. And we can dig into those models a bit.
I was going to say, so I've been on the board of TeraWulf for 3.5, 4 years now. We're sort of a vertically integrated, own the power sites, own the data centers, operate the data centers. Started off in the traditional power world, spun out TeraWulf to be in Bitcoin mining specifically, clean power, hydro, and nuclear for a point in time.
Good luck with that.
Until we sold that to Amazon because they're bullies. And then, the hydro sites that we run upstate New York recently signed a contract with Core 42, which is the hyperscaler out of UAE. Seemingly, the business is moving incrementally more into the AI HPC world. Why would a perfectly good Bitcoin miner that's vertically integrated decide to pivot their business model towards HPC and AI compute?
Okay, so let's talk about financing. The one thing that our industry is really bad at is understanding capital structure. So Bitcoin ecosystem, a lot of Bitcoin miners were equity financed in the early days because there was very little credit capacity in the Bitcoin space. That started to shift a bit in 2018, 2019, when we started to see the emergence of MiFi or mine finance, where people could basically finance. They would equity finance the build out of the facility, but they would debt finance the acquisition of ASICs, and you would deed the ASICs as collateral, and you'd get like a 90% loan to value ratio, which greatly reduced the amount of capital you needed to build a Bitcoin mine. Now, one of the challenges, and today we're sort of in this massive credit bubble in the AI space, where you have Apollo, right, the largest private equity firm in the world. They came out and they said, we're an AI infrastructure firm now. AI infrastructure is a huge opportunity for private equity because commercial real estate is underwater. Yields in commercial real estate are like 5, 6%. The rate of inflation, right, if you factor in dollar debasement, the risk-free rate, and price purchasing parity, right, per dollar, you need like a 14 to 15% yield just to keep pace with the value you're losing in holding dollars. Guess what data center yields are? 15, 18%. They're typically risk-free rate plus 12 to 14%. So you now have private equity coming in, pouring trillions of dollars into financing AI infrastructure build-out. There's a lot more capital availability, and also there's a lot more profitability because right now in GPU provisioning, people just want to buy as much compute as they can get their hands on. They're not price sensitive. 2-3 years from now, I think we'll start to see a lot more price sensitivity. What's interesting, though, I think, on the Bitcoin side is financing a Bitcoin data center is much, much, much cheaper than financing an AI data center, right? Per megawatt, the ASICs for a Bitcoin mine will cost you $1 to $2 million per megawatt for the latest gen ASICs. For a GPU data center, you're looking at 20 to 30 million per megawatt, right? So the cost differential, much higher. The issue is there's a lot more capital availability for financing AI infrastructure than there is for financing Bitcoin infrastructure. So it is an interesting shift to see. I don't think it will persist forever. And I think the other interesting factor to sort of think about, you brought up Core 42. G42, right, is a huge hyperscaler in UAE. They're building out one of the largest data centers powered by one of the largest solar installations in the world. But what issue do they have? They don't have any offtake. Who's going to buy all this compute? Same issue in Malaysia, Indonesia, all of these energy-rich sovereigns who want to turn their oil, their hydrocarbons, into compute. They need offtake. What's beautiful about Bitcoin, you don't need an offtake partner to use that compute or buy that compute. You get this thing called Bitcoin, which has an incredibly liquid market that trades 24/7, 365. So I actually think we may see some pivot back to Bitcoin mining as people start to realize how difficult it is to actually take AI infrastructure and turn it into dollars in bank account.
That's, the other important part is for a lot of these data centers, the Bitcoin miners who said, you know what, we're not making enough money in Bitcoin mining, let's pivot to AI. I think the struggle they're coming up against is there's only a handful of well-capitalized, bankable partners that they can go get project finance with. And that's the CoreWeaves of the world, the Core 42s of the world.
You're not going to compete with the hyperscalers, okay? Meta, Microsoft, Google, they're throwing off hundreds of billions of dollars of free cash flow a year. For them to take 25, 30, 40% of their free cash flow, which is $60, $70 billion a year, and throw it at AI build out, acquiring their own generation and basically vertically integrating. They own the generation asset, they own the infrastructure asset, they own the chips, and they own the distribution for the offtake because they can just pump AI products into their existing user base, means nothing to them. If that fails, it's not that big of a deal for them, and they can't afford to not do it. But as a percentage of their free cash flow, it's material, but it's not the end of the business if it doesn't work out. For AI miners, for Bitcoin miners, is absolutely a death blow if they can't sell that capacity.
Yeah, that's a problem. And then the other part of it is, in the US at least, being able to manage and integrate and be composable with the national grid is very important, and you have the ability to have flexible load as a Bitcoin miner. I think as a hyper compute cloud AI provider of power, you don't necessarily have the flexibility you do in the world of Bitcoin mining.
Okay, so let's talk about what Bitcoin mining actually pioneered. I think Bitcoin is so unique. Here are 4 things I think Bitcoin did really well over the last decade that led the way for the current iteration of data center business models. Number 1, financing and project financing structure, right? The emergence of mine finance in 2018. Yes, it ended badly, but I think it was a wake-up call for private equity, and a lot of the early private equity guys who jumped into Bitcoin and pioneered mine finance at Galaxy, NYDIG, right, was a big participant in the mine finance space. They basically figured out, wait a minute, if we separate out the chip component, which is highly depreciating, from the facility component, you actually have 2 different parts of this capital structure that you can finance at different rates to get a blended financing rate that's actually extremely attractive, 1. And you have full recourse on the collateral, which is really nice, right? An ASIC or a chip, you can take recourse of that and you can resell it or you can re-rack it somewhere. Number 2, what Bitcoin pioneered is co-location, right? So if I take my data center, my Bitcoin mine, and I put it next to the energy source, I find the lowest cost possible energy source. It started out in 2016 with hydropower in China, right, in the Shenzhen region of China. So China used to have 70% of Bitcoin mining capacity March through about July when the rainy season ended in Shenzhen, right? And that was free power, basically. There was no offtake for it. You can't have an industry that's consuming intermittent power, but Bitcoin was perfect. Then the next innovation was, what if we make the data center modular, meaning I can move it around? So Crusoe came along. I started my career in the oil industry. Shale gas wells, shale oil wells, they have a really rapid decline curve. Those assets are really only productive for a couple of years, and then you have this residual tail where you're still producing hydrocarbons, but it's not enough to build a pipeline, so it's really hard to extract that, and most people were just flaring the excess gas output. So Crusoe said, hey, we're gonna make a modular Bitcoin mine. We're gonna take a 20-foot shipping container, rack it with a bunch of ASICs, we're gonna air chill it or immersion cool it in some cases, and we're just gonna pop it down on a well pad next to a gas well that's in decline, but still producing hydrocarbons, and instead of flaring, we're gonna use that gas to power this Bitcoin mine and turn this asset that was a liability into a monetizable asset in the form of Bitcoin emitted by this mine. So this colo and the advent of behind-the-meter excess energy utilization through Bitcoin mining was incredibly important. And then the last component really was Bitcoin trades in a 24/7, 365 global, highly liquid market, unlike any other asset. And so the ability, right, to take the offtake from your data center and have a highly liquid, completely fungible asset, really valuable. A hydrocarbon is very expensive to get out of the ground, but it's just as expensive to transport. The lifting costs on an oil barrel, the lifting costs on 1 million cubic feet of gas can be really high. There's no lifting cost to Bitcoin. Once you mine a Bitcoin, it's a virtual commodity, and you can buy and sell it in the open market with 0 storage and 0 lifting cost. So I think those 4 properties really created these conditions where all of these AI data centers started to merge, and they said, wait a minute, why don't we just do this? And I've 100% conviction when I say this. Number 1, without Bitcoin, the AI boom would not have accelerated as quickly as it did, because Bitcoin pioneered this model for energy generation co-located with compute. And a lot of AI data centers were able to leverage the long-term PPAs, power purchasing agreements, that Bitcoin miners owned, number 1. Number 2, the biggest mistake Ethereum ever made was switching to proof of stake. Since Ethereum switched to proof of stake, price has been flat. Bitcoin's price over that same period has more than doubled. If Ethereum had stayed proof of work, you would have, Bitcoin has 20 publicly listed miners with an aggregate market cap of over 20 list. Okay, Circle and CoreWeave, the 2 biggest IPOs of the year, in terms of both sheer value of the IPO and post-IPO value accretion, Both started life as crypto companies in the mining. Well, CoreWeave was in the mining space. They were a GPU miner that became an AI neocloud. Circle was a place where you bought your Bitcoin in the early days, and they pioneered USDC. That's not a coincidence. If Ethereum had stayed proof of work, you'd have these huge GPU data centers, and Ethereum would have its own rich ecosystem of publicly listed Ethereum miners. But instead, you have, I don't know what, proof of work. It pays.
It does. So I guess
work.
in the current state, because we got about 2.5 minutes now left. So the current state, the optionality for a lot of these companies. So if you are a premier operator with tier 1 assets that happen to be in Lake Ontario under the name TeraWolf, you have the ability.
Okay, Mike really loves TeraWolf.
Partner with the top tier, well-financed, very bankable AI providers like a Core 42. If you're Helios, you have CoreWeave. If you're CoreSci, you have CoreWeave. There's not that many partners down the line that are well-financed and bankable. It's actually, I think to the public, it seems like everyone has a ton of money floating around, but you actually get down to the core of it, there's not that much.
If we look at all the data center builds, right, like we're looking more at data center builds now because we're making a lot of investments in non-crypto companies that are working on grid orchestration, grid optimization, demand response, which is basically where you pay a data center to turn off or lower peak demand. So we're investing in a ton of these tools. My view is like the big opportunity ahead is we need to actually start building markets for these new digital commodities, compute, connectivity, and storage. Right? That is the backbone of the digital world we live in. All are constrained, and at the end of the day, they are all derivatives of your power cost and your CapEx cost.
So basically, tech has to bring the cost down. For these ones that are operating at potentially a loss, or you have folks like the nat gas flaring and digital flaring who are operating with a negative cost input.
Okay, the biggest thing actually is you just need really liquid capital markets.
Yes.
You need really liquid capital markets. Like, I have no doubt that in the next decade, we'll see an alternative to the ISO model, right, which are these regional energy grids, and we'll see a deregulated national on-chain market for electrons. I've never been more convinced of that, and I'm going to fucking invest in it or build it.
So is this a ridiculous idea? Because I just,
No.
as we were talking, I thought about this. But basically, the infrastructure of Bitcoin mining space, for those that don't go the route of AI, do they become like the insurance models of infrastructure where they're operating at generally a loss, but they're an asset management business with a very, very low cost of capital?
I would not like that to be the case. I mean, we see now like the miners are really Bitcoin treasury companies because they're just diluting shareholders 10% every year and then using that to buy Bitcoin. Don't love that. What I would love to see is for Bitcoin miners to continue being vertically integrated, meaning they own generation, they own the infrastructure and operate the infrastructure, but they also invest in the back end, which is the capital markets, right? So again, this is where I think coming from the oil business, you had your upstream, your midstream, and your downstream. Similarly, we're now seeing the hyperscalers vertically integrating. We need more miners vertically integrating, and we need more infrastructure players in the crypto space who are owning generation, buying generation assets, who are owning infrastructure and buying and operating their own infrastructure assets, not outsourcing to a third-party DCO, a data center operator. And on the back end, what we really need, right, we have a robust liquid market for Bitcoin itself. Hash rate derivatives never really took off. We had a bunch of people try to pioneer those, but they're still really illiquid, really thinly traded. We need a robust capital market that will support the financialization of that infrastructure value chain. And basically, like the oil majors do, each one of the 7 sisters today books the majority, oil and gas companies, they book the majority of their P&L in their trading division because they're basically cost managing each input and output of the process, right? Hyperscalers are going to do the same thing. They all have massive energy trading desks. Bitcoin miners need to go the same route, vertically integrate. You own the energy generation, you own the infrastructure, and then you actually start to delve into the hedging and the capital markets that you need to control profitability through that value chain.
It all comes back to capital markets.
It's markets all the way down, baby.
So thank you, everybody. For anyone who wants to dive deeper on this, Meltem is the expert in this field.
Not at all.
Crucible.com, Crucible.
Cruciblecap.xyz, but Twitter is great. Feel free to DM me. Mike also, I'm going to tell Nazir he needs to pay you more. Great TeraWolf promoter.
I know. I am the head of the comp committee, so.
Oh.
Anyway, thank you, everybody. Appreciate it.
Thank you for coming.